Welcome back to Classic Business, and time to talk leadership transitions. And transitions in financial services are really just about a change at the top. They're often a test of continuity and culture, and importantly, client trust. Today we turn our attention to Citadel Investment Services, which has announced a carefully managed succession plan. Long-serving CEO Andrew Moller stepping down after more than a decade at the helm, and COO Sajeel Maharaj is stepping in from July. And it's a business that's grown to manage nearly 400 billion rands in client assets with retention north of 99%. So certainly the stakes around continuity couldn't be higher, particularly in a market environment that continues to test investor nerves given what's going on in the Middle East. So what does good succession actually look like in wealth management, and how do you evolve a business without unsettling those very clients who depend on its stability? Well, let's get into it. Sajeel, so good to have you on the show. And chapeau, you've been the Chief Operating Officer, deeply involved in operations and platform efficiency and client delivery and all those kinds of things, now stepping in as CEO. How do you balance execution excellence with strategic vision, and what are you hoping to bring to the role?
Thanks a lot, Michael. Thanks for having me on. As a vertically integrated business across advice, asset management, platform solutions, Citadel is a complex machine. But our strategic vision is actually really simple, and that's to be our clients' most trusted partner in building and protecting their wealth. That vision hasn't really changed in the last 33 years, and it's not going to change now. So I don't really see it as a balancing act between strategic vision and execution. Those are both inseparable in our business. Execution is really how we continue to deliver the best possible long-term outcomes for our clients. I've been COO for 8 years, as you mentioned. I've been privileged to work closely with Andrew in setting the business's strategic direction, and then also obviously in leading the execution of that strategy.
And Andrew obviously ran the business for 13 years with a very high client retention rate. 99% is envious in this market, an extraordinary number. What do you see as the biggest risk to that continuity in a leadership transition, and how are you actively mitigating it?
Andrew's been an incredibly astute leader. The biggest risk in any leadership transition is uncertainty. So clients want to know, that the philosophy, the people, and the discipline they trust remains in place. And that's why this transition has been so carefully managed. Clients continue to work with the same advisory and investment teams. They're supported by the same solutions teams. And the underlying investment approach and philosophy remains consistent. I've also had the privilege of spending 8 years working very closely with Andrew and the rest of our executive team, and we're all perfectly aligned to continue delivering the best outcomes for clients. Andrew will also continue to serve in a non-executive director role on the Citadel Holdings board, so that will also ensure a smooth transition.
What would you say have been your biggest learnings from Andrew over that period? And equally, you've described this as a continuation and not a reset, but every new CEO inevitably leaves a fingerprint or two. Where will yours be most visible in the first 12 to 24 months?
Your question touches on a really important point, and that succession planning in a business like ours is critical because the business is based on relationships, and relationships are built on trust and continuity. I've seen Andrew manage those relationships firsthand, and that's been a real humbling education. This strong focus on client relationships is exactly how we maintain that 99% client retention rate. So continuity is critical, but of course, the changing environment offers opportunities for us to serve clients even better. So I think where my fingerprint will likely be most visible is in scaling the platform. We plan on utilizing technology and AI to increase the effectiveness of our advisors, to give them more time to service their clients, also to increase efficiency in our platforms business, to increase efficiency for advisors and clients. We're also investing in talent to further reinforce the long-term strength of our teams and broadening our solution set for clients both locally and globally. And then looking externally, we're also looking at JVs and M&A opportunities to bring more talented advisors and clients into our wealth ecosystem. Lastly, many out there don't know that we actually have an exceptional asset management team called CAM, who run more than 40 funds and portfolios across the asset classes. These serve as building blocks in our client portfolios, and we're looking to make some of those solutions available to the right IFAs out there, ones that we believe we can build long-term relationships with.
Yeah, and, as part of the Peregrine Group as well, you have access to, some of the top hedge fund people in the business. And again, it's one of those businesses, you talk about scaling it, that really it was built on that human touch and that relationship. And you've scaled massively to almost 400 billion in AUM. At that size, how do you avoid becoming maybe a bit too institutional and losing that intimacy that drives that 99% retention rate?
Michael, just so that I'm clear on that point, we have 118 billion rand of assets under advice. We're a vertically integrated business, though, so we also manage funds via the asset management team and a platforms business that includes a LISP and a ManCo. So the 390 billion is actually assets under advice, management, and administration.
Right.
What's incredible, though, is that we've doubled that number in just over 5 years. That scale really provides resources and capability. That scale has allowed us to reinforce our vertically integrated model. It ensures that clients get the best outcome with the most convenience. It's allowed us to invest in talent and technology. But we know as a business that the secret sauce, our competitive advantage is, and it always will be, the depth of our client relationships. The way we manage that is by maintaining a strong advisory model where clients have direct relationships with experienced professionals. And then we use the technology to enhance the client experience and to enable those advisors. But it will never replace the human connection. Lastly, on top of that, almost 2/3 of our 450 employees are either direct or indirect shareholder beneficiaries of the business. I'm equally proud of our 12-year average employee tenure. That has created a level of alignment that you will be hard-pressed to find in our industry for our business our size. And I think that alignment is all ultimately focused on client centricity.
But at the same time, as you said, you've got to move with the times, and things like AI and technology and increasing efficiency are absolute tickets to the game in order to scale. Where do you then see the line between automation and advice? And what would you say is the one capability that Citadel must build today to remain relevant to the next generation of clients?
I really agree with that point, Michael. I mean, there's a lot of talk right now about robo-advisors and AI models making advisors obsolete. In February this year, we saw a sell-off in platform wealth managers and brokers globally after Altruist launched an AI tax planning tool. These tools absolutely matter, but I see AI technology and automation as enablers in our business. We're already using it to remove friction, to improve efficiency in the business. It's been very valuable for reporting, for portfolio analytics, for simplifying operational processes, for reducing the sort of administrative tasks that advisors had to do, such as minute taking. So if integrated properly into systems and process, it can create capacity for advisors. It will give them more time to focus on what matters, and that's the client relationships, the trust, the empathy, and the sound and consistent judgment.
It's often been a game that is about distribution and ensuring that in order to scale, you can expand and getting that advice to as many people as possible. And that's certainly where technology enables an efficiency of being able to distribute advice while keeping the kind of advisor at the center and building those relationships. Because often, if you've got a good financial advisor, these are decades-long relationships, sometimes multi-generational relationships. Where do you see the biggest competitive battleground in South African wealth management over the next, say, 5 years? I know very difficult to plan over that time horizon, given how quickly things move. But do you think it's in the platform or the advice or the price or the product? Where do you see the biggest competitive battleground in South Africa?
There'll definitely be, competition in all three of those. But ultimately, in high net worth wealth management, which is where we operate, the ultimate differentiator will be the quality of advice and the depth of the relationship with the client. I mean, there are a number of trends impacting our industry locally. You've mentioned technology, AI, scale, but also regulatory complexity, succession and the aging advisor base that we see in South Africa, the intergenerational wealth transfer that's expected over the next 20 to 30 years, and then the need for local South African investors to have global diversification. Citadel is well placed to compete on all these points, but ultimately in high net worth wealth management, it comes down to that advice relationship and the ability to guide clients through complex financial decisions and market cycles, with the right value proposition.
Speaking of market cycles, I'm sure many are getting their investment statements and looking at what's been going on in the Middle East, and it's been a tough start to the year, and wealth management ultimately comes down to behavior under pressure. What are your clients most worried about at the moment?
Absolutely, Michael. Clients are facing an extremely complex environment, both globally and locally. Globally, geopolitical uncertainty, as you mentioned, persistent inflation, question around market valuations, and then locally, political uncertainty, inequality, unemployment, and crime, persistent subpar economic growth, and low business confidence. Throw in that a volatile exchange rate. South Africa has never been a place for the timid. You throw all of that in, as well as the potential impact of technology on our economies and societies. But then the underlying long-term concern is always the same, really. It's protecting and growing wealth over the long term. Will I retire with enough to live with freedom? Am I able to leave a legacy for my kids? Our role as Citadel is to provide perspective, ensure portfolios remain diversified globally, and help clients avoid making emotional decisions during these periods of uncertainty.
Absolutely. And, really being that guide against those emotional knee-jerk type responses that more often than not are the big wealth destroyers compounded over time. Just a final one, Sajeel. Leadership can be lonely at the top. What is your leadership philosophy that you've developed, and who challenges your thinking? Who are your internal dissenters, so to speak?
That's a great question. Citadel's always been a team environment. We have a very strong exco, guys that have been on the team for over 20 years in many cases. So I have a very strong team around me that ensures consistency and stability. And it also ensures that decisions are challenged, debated, and at the end of the day, we get to what's important for the client, and that's building long-term wealth and protecting that wealth.
Sajeel, thank you very much for sharing a little bit more inside a transition that on the face of it looks seamless, but as we've heard, it's obviously underpinned by very deliberate thinking around the stewardship of your clients' wealth and the culture that you've built in long-term client outcomes, and in a very competitive industry and at a time when markets are anything but predictable. I think that consistency of philosophy may well matter more than ever. Our thanks again to Sajeel Maharaj and to Andrew Moller for the legacy he leaves behind. That's a leadership handover worth watching closely, not just for what changes, but for what very deliberately doesn't. You're listening to Classic Business.